Hello, everybody. This is Okpeyemi. Welcome to my free Forex trading course that I've started for some times now. We did lesson 1, 2, 3, 4. This is lesson 5. So if you are new to this channel, please, you can get the link to the other lessons in the description below. Click the lessons, lesson 1, 2, 3, 4, so you can catch up with this. Now, in the last lesson, we talk about many things. We talk about pips, what pips is. We talk about pipette. We talk about the bid price and the house price. We talk about the base currency and the quote currencies. I said base currency is the first currency, while the second currency is the quote currency in currency pairs. Exchange rate takes place with pairs, currency pairs. So the first currency is the base currency, while the second currency is the quote currency. Those were done in the last class. So you can click the link below to get the lessons. Now, today we have these outlines. What is a lot in Forex? Types of Forex orders. Demonstrate your way to success. Forex trading is not a get-rich-quick scheme. History of retail Forex trading. And please, once again, if you are new to this channel, please make sure you like this video, subscribe to the channel, and hit the notification bell so that when I post the next video, you get the alert. Okay, let's go on. The first outline. What is a lot? Now you can see this table. Lot, number of units, volume, and dollar per pip. Now these are the types of lots that we have. The first one is the standard lot, which is in unit 100,000. In volume, it is 1. Then dollar per piece, that's $10 per piece. What does this dollar per piece mean? It means once you enter a trade, this is what it will be reading. As in, this is what your calculation will be based on. The movement. So it starts from 10. Then the second one is the mini lot, which is in units 10,000. 10,000 units. The volume is 0.10, and the dollar per pips is 1. So meaning it reads in 1. As it goes up in ones, in multiple of ones. 1s, 2, 3, 4, 5, and so on. Unlike the first one, goes up and down in tens, 10, 20, 30, 40, and so on. And the third one is the micro lot, which is in unit 1,000. The volume is 0.01. Then the dollar per pips is 0.10. So once you enter a trade using a micro lot, the movement of your pips will be will be in 0.10. So it starts reading like that. Then if it's nano, which is the fourth type of lot, that's in 100 units, and it's 0.001 volume. Dollar per pips is 0.01. That's the way it reads. Now, what is lot? What do we mean by lot? These are the types of lots in these tables now, right now. What do we mean by lot? What do we use lots to do in Forex? Now, in the simplest of forms, the Forex lots are, as you know it, in Forex trading, is simply a measurement of currency units and a way of determining how many currency units are required for a trade. When you want to trade, it is this lot you use. So it is the one that will determine how many currency units that you want to use. So you determine that yourself. So you can use 1, you can use 0.1, you can use 0.01, and you can use 0.001, depending on you. Now, which lot size is the best? Which lot size is the best? This depends on how much of you. This depends on how much of that you want to risk. This depends on how much you want to risk and how much of your capital you actually want to risk. So the lot. I ask the question that is asked here. Say which lot is the best? It is you that will determine the lot that is the best for you. And how do you determine that? The amount you want to risk. Are you willing to risk too much money? Are you willing to reach less of your capital? So you determine that, and that will determine the lot size you will use. Once you have decided this, you will be better placed to choose the ideal lot size for yourself. So you are in the best position to choose the lot size that you want to use. And it also depends on your capital. If you have a large capital, you can use a standard lot. You can use a mini lot. You can use a micro lot. You can use a nano lot. It depends on what you want to risk. Now, types of Forex orders. Types of Forex orders. The term order refers to how you want to enter or exit a trade. That's what we call order. How do you want to enter the trade? How do you want to get out of the trade? Because you enter, you get out. You don't just enter and leave your trade, or else your whole money will be gone if you just leave it anyhow. Or the thing might just be going in profit. Depends on the direction of the market. So you enter the market, you get out of the market. Now, how you enter the market and get out of the market is what we call order. Forex orders. Sorry. Now, different brokers accept different types of Forex orders. Types of orders. The first one is the market order. A market order is an order to buy or sell at the best available price. With this type of order, you see the price that is on. Then you click on buy or sell. You enter the market. Or I can just call it current price. You buy at the current price, the price that is on. So you enter the market. Whether you buy or you sell, you just enter the market immediately. Some brokers call it instant execution. Some call it market execution. So you just enter the market immediately. Immediately you see it manually. For example, the bid price for Euro USD is currently at 1.2140, and the ask price is at 1.2142. If you wanted to buy Euro US dollars at market order, then it will be sold to you at the ask price of 1.2142. You will click buy and your trading platform will instantly execute a buy order at that exact price. The last time I showed you the ask price and the bid price. So when you want to buy, you buy at the ask price. When you want to sell, you sell at the bid price. So you will see it once you open your trading platform. You will see it. You see the codes. You see it there. So then you just click your trade, and it is executed immediately. So you will click buy and your trading platform will instantly execute a buy order at that exact price, unless there is internet problem. That is when it will not enter at that price, because price is not static. It moves. So it moves. So you also have to use a strong internet so that you buy at that price you want to buy and sell at the price you want to sell. The second one is the limit entry order. The limit entry order. The buy is called buy limit. You see, it depends on your broker. You see, buy limit. Then the sell is called the sell limit. Now, a limit entry is an order placed to either buy below the market or sell above the market at a certain price. That's limit order. Limit order means, okay, for example, buy limit. Buy limit. It means you won't get in the market immediately, unlike the other one, the market order. That one you get in. Once you see the price, you get in. Once you see that this is the price that you want to buy, the bid price is showing the price you want to buy. So you quickly click on the trade, and the trade will be executed immediately. But the limit order, this one is different. Maybe you are seeing a particular price, but the price is not there yet. So you want to buy at that particular price. Okay, let me see. For example, okay, let me explain it this way. For example, you want to place a buy limit. You are expecting that the price will go down to a certain price, and once it gets to that price, then your trade is executed executed, and you are believing that once the price goes down to that particular price, it will continue to go up. That means it will reverse. Let me just put it in that way. You are believing that price will reverse at a particular price. So that's what we call limit order. It means price will reverse. It means once the market gets to a particular price, it will reverse and turn the other side. That's the meaning of limit order. Then sell order. It means that you expect that price will go up and hit a particular side and drop. So you expect that price will go up and come down at a particular price. Now, for example, Euro USD is currently trading at 1.2050. You want to go short if the price reaches 1.2070. Now, look at it. Price is currently at 1.2050. But you believe that if it gets to 1.2070, that means if it goes up to 1.2070, you can either sit in front of your monitor and wait for it to hit it. At which point you will click a sell market order. That's if you want to do it manually. You can wait for price. You can wait for it to get to that 1.2070. Then you quickly enter the trade. Or you do it automatically. You use a limit order. You place a sell limit. Just go there, place a sell limit, put the price that you want to sell. So once the price gets to that particular price, the trade will be executed. Or you can set a limit order at 1.2070. If the price goes up to 1.2070, your trading platform will automatically execute a sell order at the best available price. At that particular price, you put it. That's where it will enter. So the same way for buy. You just put the price there, put your stop loss, put your target. You may not even put those ones first. You may put them later. So you just put the price that you want to buy. So then you place the order. Now, it will not enter the market immediately. It will be there, rolling, moving up and down. Once it gets to the price you want to buy, it will be executed. The third one is the stop entry order. The stop entry order is an order placed to buy above the market or sell below the market at a certain price. Now look at this one. The limit order has to do with reversal. You believe that once price gets to a place, it will reverse and come down or up, as the case may be. So, but this one is the opposite. This one, stop order, means you are expecting that once price gets to a particular place, it will continue. So if you want to buy, okay, let's say for example, GBP USD is currently trading at 1.5050. 1.50 and it's heading upward, it's going up. You believe that price will continue in this direction if it hits 1.5060. So you can do one of the following is to play this belief. Sit in front of your computer and buy at market when it hits 1.5060, or you set a stop entry order. They call it buy stop. Some brokers call it buy stop. So you just use that. Once price is out that particular price, which in this case now is 1.5060. Once price gets to 1.5060, your trade will enter. It will be executed. So you use stop entry order when you feel that price will move in one direction. So you use stop entry order. We have buy stop, we have sell stop. So you use it when you feel that price will continue. That's it. That's when you use it. But unlike the limit order, you use it when you feel price will reverse. So limit order, you use it when you feel price will reverse. But stop order, you use it when you feel that price will continue. That's just the difference between the two of them. Then the stop loss order. Stop loss order. A stop loss order is a type of order linked to a trade for the purpose of preventing additional losses if price goes against you. Remember this type of order. A stop loss order remains in effect until the position is liquidated or you cancel the stop loss order. Now, what am I trying to say here? When you enter a trade, as I was saying before, you put your profit target and you put your stop loss. What is this stop loss? Stop loss means you don't want to incur additional loss. That means you are already in loss. Maybe your trade is going against you, so you are in loss. So you now put a stop loss there. That once it gets to this particular price, please get me out. I don't want to lose more again. That's the meaning of stop loss. Now once the loss gets to this particular price, please get me out. That's the meaning of stop loss. And it is very important in every trade. Very, very important. If you don't use it, your account can be wiped off in just one trade if you don't use a stop loss. But once you use it, once you get to that price that you feel you don't want to lose more, it takes out loss. It stops the loss, and you are out of the market. For example, you went long, that's buy, Euro US dollar at 1.2230. That's your entry price. Your entry price is the price that you entered the market. So to limit your maximum loss, you set a stop loss order at 1.2200. And when you buy, you expect the price to go up. So meaning your stop loss must be the price that is lower than the entry price. You can see entry price 1.2230. Stop loss must be lower, which is 1.2200. This means if you were dead wrong and Euro US dollar drops to 1.2200, Instead of moving up, your trading platform would automatically execute a sell order at 1.2200, the best available price, and close out your position for a 30 pips loss. You remember we talked about pips. That's 1.2230 minus 1.2200. That's 30 pips. So that means you have lost 30 pips. So that's the work of stop loss order. It is very important. As time goes, as we go on in this course, I'll tell you more about stop loss, how you should take a stop loss, and the rest. Let's continue. And the fifth one is the trailing stop. Trailing stop. A trailing stop is a type of stop loss order attached to a trade that moves as price fluctuates. Let's say that you have decided to short. That's called short, sell. When I say short, I mean sell. So you have decided to sell USD JPY at 90.80 with a trailing stop of 20 pips. This means that originally your stop loss is at 91.00. When you are selling, your stop loss price will be higher than your entry price, because when you are selling, you expect price to go down. So if it goes up, that means it is going against you. So your stop loss will be set higher than your entry price. If the price goes down and it hits 90.60, your trailing stop will move down to 90.80 or break even. Let me explain trailing stop better. Trailing stop, you do a trail stop when you are already in profit. That's when you do a trail stop. That's when you do it. Unlike stop loss. Stop loss, you are already in loss. So you want to exit the trade in loss. So you set the price that you want to exit the trade in loss. But trail stop, you are in profit already. So, but you don't want to exit the trade because you want your trade to hit the profit target you have set there. Because you would have set a target and it has not got to your target, and you don't want to risk your profit again because you are already in profit. So will it be okay if you are in profit already and you now go back to loss? That would be a bad trading. So what will you now do? You will remove the stop loss and put a price to take some profit, or you put it at entry price. So what is a trail stop? A trail stop means moving your stop loss in the direction of your trade. That's a trail stop. When you move the stop loss, you have set a stop loss before, but you are now in price. You are now in profit. So what do? You remove the stop loss, then you put the entry price. So if price comes back to the entry price, you will be at break even. So you will not lose anything. So you just have zero, no profit, no loss. But if you move your stop loss to profit, you move it to profit. So that means if price should come to where you set it, where you have put your stop loss now, so that means you just get that profit. You won't be able to get the target because price came back. to the trail stop. So that's the meaning of, that's the difference between a trail stop and a stop loss order. So that's the difference. Now demonstrate your way to success. The first thing you need to do is to trade on a demo account. So you go to a broker, you open an account with them, then you start practicing. That's demo trading. A demo trade is just like a real account. Some people say demo trade is fake or fraud or is not real. No, demo trading is just like a real account. The only difference is your psychology. When you are trading real accounts, your money is there. So your psychology is, you are not relaxed because you know that your money is at stake. But unlike when you are trading demo, it's just a virtual money. It's not your money, so you might be relaxed. You might feel relaxed. That's the only difference between a demo account and a real account. They are the same. The same thing happens there. When price is going up on a demo trade or on a demo account, is there on a real account too. So the only difference is the psychology. You can open a demo account for free with most Forex brokers. These pretend accounts have the full capabilities of a real account. But why is it free? It's because the broker wants you to learn the ins and outs of their trading platform and have a good time trading without risk. So you fall in love with them and deposit real money. The demo account allows you to learn about the forex market and test your trading skills with zero risk. So all these things you are learning, you just go and practice them on a demo account, not a real account. As you learn, you practice. So then as you get better, when you have now feel confident, no, I have known this thing, then you can now go live. Now, look at this. Forex trading is not a get-rich-quick scheme. Forex trading is not a get-rich-quick scheme. A lot of people believe that once you trade Forex, you make millions overnight. No. It's a gradual process. If you take it as a get-rich-quick scheme, you will lose your money. Why? Because you will not follow the rules. And once you don't follow the rules, you lose. All forex traders, and we do mean all traders, lose money on trades. You see, losing is part of forex trading. Losing. You heard me right. Losing is part of forex trading. There is nobody, I've not seen anybody who has not lost in forex trading. The only difference between the losers and the winners in forex trading is that the winners, they win more trades than the trades they lost. While the losers lose more than their wins. So 90% of traders lose money, largely due to lack of planning, training, discipline, and having poor money management rules. If you hate to lose or are a super perfectionist, you also probably have a hard time adjusting to trading, because all traders lose a trade at some point or another. If you hate to lose, you don't like to lose, you will make mistakes, then you lose more. That is it. That's why that stop loss is very important. And once you have set it, don't say, now let me remove the stop loss because I don't want to lose. If you remove the stop loss, you lose more. So you leave it there. You leave the stop loss there and allow it to hit it. Or if you believe that the trade is going wrong, no, the better thing is just to leave it. Leave your stop loss and let it hit it. Then you plan yourself. What did you do wrong? That means so you can do better the next time. Not that you say, I don't want to lose, then you now remove the stop loss. As some traders do. They will now move the stop loss below or higher. What have you done? You have increased the risk. You increase your risk. And price might go there and hit where you have put it again. So you have now lost more. So the better thing, that's why one of my mentors, he said, never move your trade. He said, always move your stop loss in the direction of your trade. Always move your stop loss in the direction of your trade. That's trade stop, trailing stop. Meaning, once you are in profit, move your stop loss to entry or to profit. Then and leave the trade to go and hit your target. So, 2, trading forex is not for the unemployed. If you believe, I don't have a job, so then the next thing for me to do is to go and do forex. No. Because forex requires education. You go to school because you want to learn, you want to gain degrees so you can make money. Is that not why you go to school? The same thing applies to forex. If you want to make money in forex, you need education. And that's what I'm giving you right now. You need education. Don't just take your demo account and start practicing. Like I did that before, and I wasted a lot of time practicing on demo without education. I did not have any education. I was just practicing, and I did not understand. I kept on losing, winning. I was even using signals from strangers, people that I did not know, using their signal. But later, when I now discovered that no, forex needs education, so I started learning. I started reading books, and I started improving. Now, history of retail forex brokers. We mentioned this when we were talking about the history of forex. Now, before we could we retail traders, we couldn't trade. It's because of the help of the retail forex brokers that we too can now trade. Why? Because of the large volume involved in trading. Before, the super banks, the big companies, the big banks, they were the ones trading, the government. But now, with the help of the retail forex brokers, we too can trade and make money. In fact, forex junkies probably wouldn't exist if not for the birth of online forex brokers. You see, back in the 90s, it was much more difficult to participate in the retail FX market because of higher transaction cost. At that time, governments were like street parents, keeping a watchful eye on exchanges, restricting their activities. After time, the CFTC decided that enough is enough. They passed a couple of bills, namely the Commodity Exchange Act and the Commodity Futures Modernization Act, and opened the doors for online forex brokers. Since almost everyone had access to the World Wide Web, opening an account with a forex broker was simple and convenient. Various forex brokers started popping up here and there. They started popping up here and there, and eager to take advantage of the booming forex industry. But now that there are many choices out there, it is a little tougher to distinguish between the good brokers and the evil ones, because there are good brokers and there are bad brokers who will manipulate the market to favor them. There are bad brokers, there are good brokers. Later as we progress, I will tell you, we will talk about more about the brokers, the good ones and the bad ones. So that's the end of the lesson for today. And please make sure you subscribe to my channel. If you are new, if you have not subscribed to this channel, please make sure you subscribe. Click on the like button, subscribe to it, and hit the notification bell so that when I post lesson 6, you'll be able to get the notification.